Many people think the 4-year cycle has ended. $126,000 was the top for Bitcoin, and we're only going down from here. But what if I told you the math proves that the 4-year cycle never really existed? Astrophysicist and mathematician Stephen Perrenod joins me again to discuss why Bitcoin mathematically outperforms gold, why the volatility is fading, how the 4-year halving cycle narrative is false, and why bubbles are actually spaced out by math and not by calendar years. Stephen reveals why the power law and his new insights point to a new date for the next major Bitcoin bubble, and it's further away than you think. All right, let's dive in. All right, Stephen Perrenod, welcome back to Bitcoin for Millennials.
Oh, it's great to be here with you again, Bram.
I'm a student here. The audience here is a student. So I'll just listen to your new findings and try to ask clarifying or maybe even some noob questions, probably. And I'm excited to dive in and see what you've been focusing on. So let's just go into it.
Great. Well, I've been thinking a lot about bubbles all year, as to whether we were going to have one and how big it might be and when it might be. Mm-hmm. And looking at the history of bubbles and seeing that they were fading, and wondering whether we were going to have bubbles in the future. But in the last month, I've kind of made some progress. Significant progress, I believe. And I also want to talk about relative to gold, because it's been a good year for gold and less so for Bitcoin. And so I don't want to sweep that under the rug. I want to address that head on. So on this first slide, this gentleman was the master of the Royal Mint. His name you're familiar with. It's Isaac Newton. And a lot of people don't know that he spent just as much time, down in London as he did in Cambridge. He spent about 30 years as master of the Royal Mint in London after his, time in Cambridge. So I'm actually going to talk just a little bit about alchemy and energy, because he was quite into alchemy, which, at that time, the distinction between chemistry and alchemy was unclear, shall we say. And then I'll get into just briefly remind you of the distinction between the way a power law behaves and the way exponentials behave. And then I want to get into a discussion of Bitcoin relative to gold. And that will be the power law measured in gold terms. In other words, Bitcoin measured in ounces. I'll also look at the Kelly criterion. If you have a 2-asset portfolio, how much would you put into Bitcoin? How much into gold? And then I want to look at the bubbles. And I have a thesis I'm presenting the last few weeks that the bubbles are really spaced in logarithmic time, not in linear time. So I'm dismissing the idea of a 4-year cycle. And then I will talk about Bitcoin versus the dollar, just some of the latest regression. If we have time, I'll talk about cities versus companies and also a cosmology analogy for Bitcoin. So people know Newton from calculus and from gravity, and that was in the 1660s with calculus, and he published Principia and laid out Newtonian dynamics in 1687. But then 10 years later, he became master of the mint, and he held that job, pretty much until his death. So for 3 decades. And he also, while at Cambridge, worked in the area of alchemy. And you can make an analogy between alchemy and Bitcoin, and here it is in this table. Alchemy has this sort of raw material that they want to transform into gold, and they use some sort of crucible or furnace, and then there's a catalyst, which they call the philosopher's stone. So maybe the idea was, could you turn lead or a base metal into gold with some alchemy process? And so transmutation into gold and a quest for eternal value. And it was also tied in with the quest for immortality. Well, Bitcoin has some analogy to all of this. For us, electricity is the raw substance, and the crucible are the ASIC miners. And of course, on that, there's the catalyst, which is the Nakamoto consensus. And that is what enables the miner, which is just a piece of hardware. It's true that the hardware is optimized for running hashing, but running hashing is not enough to complete everything. You need to run the full Nakamoto consensus. So that's the catalyst that then at the other end actually creates Bitcoin and then puts it out for eternal value on a hard-capped and incorruptible ledger. And the idea of energy as digital money has been around for 100 years. And I think the earliest reference I can find is this Nobel Prize winner in chemistry, not alchemy, but chemistry, Frederick Soddy. And in 1921, just over 100 years ago, he published a little pamphlet called Wealth, Virtual Wealth and Debt. And he saw wealth as originating from the transformation of energy. And he noted that debt grows exponentially. Real world wealth has growth and decay. And he called for an energy currency. And people are more familiar, I think, with Henry Ford's calls for this, something like this in the 1920s. Buckminster Fuller in 1969 talked about it. And then the whole process that led to Bitcoin kind of started with David Chaum and digital money in the 1980s. And there are many, many contributors over more than 4 decades that, led to the publication of the white paper in end of 2008. Now, a reminder that power laws are not exponential and they're not compound annual growth rate. We find, in physics, we find power laws everywhere. There are 4 fundamental forces. 2 of them are kind of pure power laws, gravity and electromagnetism. It gets a little more complicated with general relativity, but if you take Newtonian gravity, it's just a 1 over r squared force. And electromagnetism is similar. And then the other 2 forces are nuclear forces, the strong and the weak force, and they have power law components as well as some other components. The weak nuclear force has a decay component because it governs decay, and then the strong nuclear force has a very strong spring component that confines the quarks. And here's some other examples. The first one is just the simplest kind of power law for a black hole, that the radius is proportional to mass, which is not what you expect for the Earth, right? But this is how it behaves for a black hole. There's the event horizon radius is just a linear relationship. It's kind of the simplest kind of black hole. If you have 2 that are spiraling around each other and eventually merge and create gravitational waves, then you have a steep power law where the time to the final merger increases very, is very sensitive to the distance. And so it's very long as the distance is large. And a couple of others. The last one is the Higgs force, and it shows both square terms and the 4th power term. So you can get rather steep relationships in physics. And that's what we see with Bitcoin. It's a steep power law. Here are 2 graphs to show the distinction between exponentials and power laws.
I think that is very interesting in kind of like a tension or discussion type of sense, that these ways to look at like traditional finance and traditional assets is not necessarily the way you should look at Bitcoin, apparently, right? Like that is why I'd say the power laws of discovery is like, okay, this Bitcoin thing is behaving very differently than traditional assets, like how people looked at that before.
And the foundational explanation for that is that Bitcoin is first and foremost a network.
Yes.
It's a technology, and it manifests as a network, and it's actually a meta network. There are many different sort of complementary networks. Just for example, there's a network of miners, and there's a network of full nodes, and then you have exchanges, and so forth. And so you get network effects. And what we know is from communication networks, and this is true for the internet, certainly, that you get these kind of square effects where the value of the network grows with the square as the network scales to more and more users. Mm-hmm. And it was true for the telephone system, and it was true during the history of the internet. It followed a power law, and it eventually saturated. So it's saturated eventually at 5 billion or whatever.
Yeah.
And really, Bitcoin is the internet plus money, right? And so this power law that it scales is rather similar. But we also find the power laws in things like the hash rate So it's not just the price, it's the address count, it's the price, it's the hash rate. And some other attributes show this kind of parallel behavior.
When it comes to holding Bitcoin securely, peace of mind starts with architecture. OnRamp's multi-institution custody model distributes control access across 3 independent regulated key holders in a 2 of 3 multi-sig quorum. No single point of failure, no pooled or omnibus exposure, just segregated client-titled vaults. You retain full legal ownership while OnRamp coordinates security, compliance, and operational workflows behind the scenes. Multi-institution custody is the foundation for everything that OnRamp builds. Sound infrastructure that distributes counterparty risk and provides fault-tolerant resilience with clear audits and institutional controls. And now OnRamp is piloting flat, predictable pricing to make best-in-class Bitcoin custody and financial products more accessible than ever. Visit onrampbitcoin.com to learn more and sign up with code BRAM, that's BRAM, to receive $150 in Bitcoin after your first deposit. OnRamp, strength in many, simplicity in one. My American friends, I've got something for you. If you're into Bitcoin, you want to grow your stack in any way possible. What if you could do it effortlessly just by spending your fiat? The Gemini Bitcoin credit card is designed to help you do just that by giving you instant Bitcoin rewards on every purchase. Just use it like any other credit card and earn back up to 4% on transportation, 3% on dining, 2% on groceries, and 1% on everything else. There are no annual fees for this card and no exchange fees to receive your Bitcoin rewards. Sign up to get your limited edition Bitcoin Orange credit card and earn a $200 Bitcoin bonus when you spend $3,000 in the first 90 days. You can find more information and terms in the description below or go to gemini.com/Bram to sign up today and start stacking effortlessly. That's gemini.com/Bram.
So exponentials have a time scale. And you can say it's the time scale to grow by a factor of E, the base of the natural logarithm, or you can say it's the time scale to double. And for people that know the rule of 72 in finance, if you get 8% compounded, it takes 9 years to double. And that'll happen again and again. It'll keep doubling like that. And so if you plot it log linear, which is the one in the center of the slide, and the orange line for an exponential, it's just a straight line on a log linear. So you'll see a lot of charts. You'll see in finance with stock charts, you'll see linear charts or log linear charts. You never see log charts. You never see ones that are logarithmic in time in TradFi. Now, a power law will start out and look more steep than the exponential and eventually will be less steep. Now, if you look on the right-hand side, it's log. And in a log plot, a power law is straight. And there's no characteristic time scale. You have to know what the origin time is that's relevant, or the origin position if it's like gravity or something. But there's no fixed doubling time. And I'll show you later how the doubling time changes and how the growth rate changes. And so the power law can be more steep than the exponential depending on what the actual values of the parameters are, and eventually less steep. So in these examples, they're actually tangential at the same price point, but then they have very different behaviors in the past and in the future. Okay, let's get into Bitcoin versus gold, and I'll give you a very simple example that shows that gold does not follow a power law of time. And, people would not naturally think that, since gold's been around for 5,000 years, and we're sort of comfortable with the idea of what the gold prices were. Most people have a rough idea what it was 10 years ago and 20 years ago. And this just shows annual prices for 15 years. And, in the first of the year. And then instead of age, I've got log 10 of age, and I've got log 10 of the Bitcoin price in dollars. And then the next column has log 10 of gold in dollars. And then the final column has the ratio. So it's Bitcoin measured in gold ounces, but it's the log of that quantity. So if you take the slope, comparing the third column to the second column, that slope is 5.84, and that's the Bitcoin power law. It's about 5.8 slope. If you take the last column and calculate the slope relative to log age, so log of Bitcoin measured in gold ounces versus log age, just do this in a spreadsheet, slope is 5.5. So one reason to test against gold is, well, people sometimes say, well, what about inflation? The dollar inflates, the money supply goes up about 7% on average. And this eliminates most of that objection because the gold supply increases about 1.5% to 2% per year. So most of the inflation objection is eliminated if you put gold into the denominator. And you still see a power law. And you look at the R squared, for Bitcoin dollar, it's 0.96, and for Bitcoin gold, it's 0.94. So it's very, very high in both cases. Now, if you try to do log gold power law against log age, you get a slope. You're going to measure something, but the R squared is very low. It's 0.28. So it's not a good fit. And in fact, it fits well with a 7.4% compound annual growth.
And as a reminder, the R squared is the amount that measures how statistically correct it is, right?
It's the quality of the fit. Yeah. It's the correlation coefficient squared
of the data you're trying to correlate, right?
Right. This is just ordinary least squared, and so it's looking at how well the two series align.
Yeah.
And it's very high. 94, 95 is a very high correlation. It's a rare thing to see.
Yeah. One is the highest too, right?
Right. Basically 100%, it would be one, right?
That would be like a perfect correlation, basically.
Right.
Okay. And so gold, your point here is that gold versus dollars, there is no way to predictably to predict.
No, you can predict it on very long periods. It keeps up with inflation, right?
Yeah,
roughly. So it kind of keeps up with the money supply. The money supply grows at 7%, and gold has been growing at about 7%. And some years it'll do much better, and some it won't do. And it's got a lot of volatility, not as high as Bitcoin, but over 50 years, you see the same sort of thing. It basically keeps up with the inflation. I mean, to first order. Obviously, gold supply has also increased some. Bitcoin has work to do to prove itself
exactly.
The larger world, right? That is more invested in gold.
Yeah, I agree.
Okay. This is just a graph of what I showed before, essentially. So you can just take these annual points and you can see that Bitcoin measured in gold, it's a log chart. So what we're seeing on the x-axis is the log age. So where it says 1.0, that's 10 years of age. So that's beginning of 2019, right? And now we're a little over 1.2 in log 10 terms. And so, first thing to notice is the points get closer and closer, right? Because a year is getting shorter and shorter on a log chart, right? And actually, if you're going to do the regression right, you would have points that are equally spaced in log terms. And I've gone back and done that for Bitcoin dollar, and it doesn't change the results. We've got enough data that we're determining it well. But this just gives you a feel. And the band is sort of the uncertainty. And you can see, the points mostly lie within the band. That's the 1 sigma plus or minus 1 standard deviation. So Bitcoin is a power law in gold. It's a little bit less than you see in dollars. It's about 5.4, 5.5, depending on what data you use. This is just the correlations between Bitcoin and stocks and gold, and it shows that Bitcoin has been more correlated with tech stocks than it has with gold. But the first thing I want to call your attention to is the chart in the upper left. And it goes back to 2011, a little bit earlier than 2011. Bitcoin went up in value by over 100,000 times. Gold went up in value by less than 3 times. You just don't hear the gold buys talk about this too much, right? They kind of like to look at the most recent year when they've had a good year. But if you look at the vast sweep of Bitcoin history, there's just been no contest. Bitcoin has just been displacing in terms of relative terms. It's gone up over 30,000 times, 40,000 times in relative to gold. Now it's about 20 ounces, and at one time it was like 1,000th of an ounce. The slide below that shows that this is the Granger causality test, and it shows, do Bitcoin prices or gold prices lead? And in fact, it's got both curves, and the blue curves is testing whether Bitcoin leads gold. And here you want to be low on the slide. You don't want to be high on the slide. This p-value is just what's the probability that you can produce this with random numbers. And so the Bitcoin gold blue line, the numbers being high means that there's no correlation or causality here of Bitcoin prices leading gold prices. But on the other hand, the gold colored dots, gold leading Bitcoin by anywhere from 2 to 12 weeks, they're all below the 5% level. And that's where it becomes statistically significant. So gold prices do lead Bitcoin, and it can range from a few weeks up to a quarter kind of a thing. So that's kind of something we've had going for us. It gives us a little hope that we'll maybe see some shift into next year, better performance for Bitcoin. And the slide on the right shows the rolling 52-week correlation of Bitcoin and gold. And you can see sometimes it's positive and sometimes it's negative, and it moves around a lot. It's hard to conclude very much about that. It's an unstable kind of relationship. This year, they've been, not too well correlated.
Mm-hmm.
Okay, this shows a more complete Bitcoin versus gold regression, and it shows both ordinary least squares tests and quantile regression tests that are done at 5 different levels of 0.1, 0.3, up to 0.9, and those are the dashed lines. And then the solid line in the middle is the ordinary least squares test. So if you look at the line that's green dashed, it's close to the solid line. That's the median in the quantile regression. And it turns out they both give a power law index of 5.3, and the uncertainty there is small, just 0.02, and the R squared is high, it's 0.94. But the trend values would be much higher than we see today. They should be around in the high 40s or low 50s ounces. Based on that,
it should be double almost.
It should be. Actually, we're down at about 20 ounces right now.
Wow.
So it should be, because gold keeps hitting new highs. I think it just hit 4,400. So we're around 20 ounces, and we should be above 40 just to be at the power law, long-term power law trend. So we can say, well, yeah, okay, we're down below the 10% level. It's a little bit concerning. It's certainly weak performance. And if that continues, you would start to measure a somewhat lower power law index. And in fact, we've done that over the last couple of years. It's lowered a little bit. But it doesn't break the idea of a power law.
Yeah.
And so the assumption would be we'd get some restoration and it would, revert at some point. We've actually modeled how this behaves, and there is this kind of springiness to it. And I've done this in both gold terms and in dollar terms, where you get restoration back, from a bubble or from a trough, you get restoration back.
Yeah. I have a question about this, because I think what is, I'd say, difficult to understand, you just correctly said, Bitcoin still has to prove itself, right? I think that is more like conceptually rather than price-wise, I mean, they're kind of intertwined, right? Like if you understand that Bitcoin is superior, has superior characteristics over gold, that's one, but like acting on that is two, right? So I think there's just a big learning curve there for a lot of people, right? And then based on that, it's either people buy Bitcoin or they buy gold, right? Other people don't understand that, just like gold, you shouldn't really trade or leverage Bitcoin, although you can do that 24/7, 365, right? That's why we also see a lot of leverage and, increased volatility, etc. So I think that's also like another part of just the understanding of Bitcoin and how people handle that. So there's kind of like this qualitative understanding learning curve, and then when you look at like the power law, right? For me, the essence of the power law is, apparently there's a predictable way to look at Bitcoin's adoption in several different dimensions, including price, like you said, hash rate, nodes, etc. Right? Like that is the discovery and the connected theory. So when I look at this slide, the conclusion basically is Bitcoin is undervalued or mispriced, whatever definition you want to use, right? Based on the power law that up until this point has proven itself with also this high R squared, right? So I think that is what together creates this conclusion of Bitcoin is currently underpriced. How can other people think through that in ways of kind of like judging the math versus the sentiment versus the perception versus the I don't know, like the understanding of the market? Does that make sense?
Yeah, absolutely. And, the market is right in the short term and the math is correct in the long term. I think Buffett talked about voting machine and weighing machine, right? Which actually goes back to Benjamin Graham. So the voting machine is the short term, it's the market now. The weighing machine is the math, the long term. What is the fundamental for Bitcoin? The thing to keep in mind, of course, is that the volatility is very large. So the volatility is sitting there in logarithm space. And everybody gets all excited because Bitcoin moves $5,000, but that's noise. One standard deviation is 0.2 in log 10. And 0.2 in log 10 is a factor of 1.58, a multiplicative factor of 1.58. So if fair value were at 100,000, and now it's higher than that, but if it were at $100,000, then to move by one standard deviation, you'd have to get to $158,000. To move to one standard deviation on the downside, you'd be below 70,000. So that is it's normal to be in the 70,000 to 150,000 kind of range. This is another way of looking at the persistence of Bitcoin. It's called the Hurst exponent. I'm not going to go through the method. I think I did it on your show half a year ago. What the method does is it changes the window size of the data that it's looking at, and it measures the full range of variation in the data, and also measures the statistical uncertainty, the standard deviation, and it looks at the ratio of those two. And it finds as you grow the window size that actually that ratio has a power law behavior. And normally this Hurst exponent is between 0 and 1. And if you have a random process, it's going to be 1/2. And if you have something that's reverting to mean, it's going to be near 0. I took 10 years of the SPY, which is the SP 500, ETF, and it has a value of 0.18. So that indicates strong mean reversion. For Bitcoin, and you have to do this with the residuals. And normally what people do is they just take the kind of log variation day to day because they're assuming a kind of compound annual growth process. But for Bitcoin, if you take the residuals after taking out the power law, then you find that this Hertz exponent is 0.9. And it doesn't matter whether you do it in gold or dollars, daily or weekly. It gets stronger if you do it daily. It's very, very high. It's like nothing one sees. So this is a measure of very long-term persistence. It's another way of saying that Bitcoin has embedded alpha, if you will.
What does that mean?
It means long-term outperformance.
Right now, through 2025, Blockstream is running their biggest sale yet. 21% off the Blockstream Jade Plus right in their store, and your price is adjusted at checkout. This is the lowest price you'll see all year on the most trusted Bitcoin-only hardware wallet on the planet. The Blockstream Jade Plus is the simplest, most secure way to protect your Bitcoin. With a sleek design, full color display, and a dead simple setup, you'll be securing your sats in minutes. And pair it with their Blockstream app for the smoothest onboarding, offering advanced features like air-gapped setup, QR mode, and native multi-sig support as your stack grows. Go to store.blockstream.com, where the 21% discount is active through December 31st. And if you use my code BRAM, that's BRAM, you get an extra 10% off your order. Let's talk about something that not a lot of people think about before it's too late. Where are you storing your Bitcoin seed words? Are they truly secure? I found my solution with StampSeed. It's an elegant all-in-one titanium plate solution with no separate pieces to lose or manage. Your seed phrase gets permanently stamped into pure titanium that withstands fire, survives water, and lasts for generations. Unlike shallow etching methods, StampSeed's patented tools help you to deeply stamp every letter for permanent readability, protecting your financial legacy. When you order a titanium seed plate from StampSeed, you can also upload a custom design or your logo to customize the back of your plate to make it fully personalized. Paper seed phrases are a disaster waiting to happen. Secure your Bitcoin with StampSeed for decades to come. Visit stampseed.com and use code BRAM, that's BRAM, to get 15% off your order.
Okay, now I want to look at the Kelly criterion for optimal log wealth. Shannon is the guy who figured out entropy for information, and John Kelly was one of his associates at Bell Labs. And in the early 50s, he published his criterion, and it's derived from the entropy of information criteria, but it's applied to a kind of betting process or investing process.
And we talked about this last time, right? Like the Kelly criterion is a way to calculate your portfolio allocation over a certain amount of time.
So and I'm going to show you some update and comparison Bitcoin versus gold if you had a 2-asset portfolio, and also a different method that would include stocks also. And you could do this with Master against Bitcoin if you want to, but I'm not going to show that today. And this is just, think about what's minted, what's mined, and what's printed, right? Bitcoin's minted, gold is mined. Bitcoin's not really mined. We don't dig into the ground. We mint it.
Yeah.
These are 10 years of annual returns with 16 different asset classes, half of which are debt kind of classes, so they don't have huge returns. So I'm going to throw those out in the next chart. But Bitcoin from 2015 to 2024 won 8 out of 10 years. It was number one amongst these 16 asset classes. And you can see gold bounced around. And of course, Bitcoin was the biggest loser also, too, when it had the lowest return. The gold is in dark green, so you can see where the gold was. But now I took out the bond ones because they don't return a lot. And so I've got 8 asset classes here: Bitcoin, broad tech, large and small caps, real estate, gold, commodities, international equities. And I apply this Kelly criterion. Now, the way it works is you look at not how many years did it come in first place, but you look at how many years did it outperform. So the first thing you can do is just cash. Did it outperform cash? And you can do that with or without a risk-free rate for the cash. And for Bitcoin, it was 8 times out of 10. So this probability which is the first term in the Kelly fraction F, is 0.8. Then you have to subtract out your losses, but you divide your losses by the edge that you have. So you actually get two edges in this formula. The first edge is if you win more than half of the time, and that's the P and the Q, right? The P is the win percentage, the Q is the loss percentage, P plus Q is 1. But the B is the ratio. If your wins are bigger than your losses, then that's a second advantage. And so if your wins and losses were equal, you'd say P minus Q. So if you had a process where you won 70% of the time and you lost 30% of the time, P minus Q would be 40%, and your optimal portfolio allocation would be 40%. That would be the maximizing the growth of your log wealth. But you can allocate more if your wins outperform your losses. Well, for Bitcoin, they do very substantially. In fact, the average win was close to 300%. The average loss was about 70%. So this B ratio is 4.2. That means the F is 75%. So it would tell you that in a two-asset portfolio with dollars, you can allocate 75% to Bitcoin. Now, in the next two columns, I make adjustment for earning a T-bill rate, and I set it to 4 as a risk-free rate. It's still 75% in the case of Bitcoin. If you go through this for technology, you had a high win rate in recent years, and it comes out to be 60, 65%, 66%, depending on whether you apply the risk-free rate. Small caps didn't work out at all once you applied the risk-free rate. Large caps were okay because they're not that different from broad tech lately. And after the risk-free rate, it would be a 40% maximum allocation in a two-asset portfolio with dollars. Real estate was a loser once you apply the risk-free rate. And gold did well, but once you subtract the risk-free rate, you have a problem because, look, gold had an average win of 13%, but it had an average loss of 8%. If you subtract 4% from this, it's down to 9, and if you subtract 4% from this, it's minus 12, right?
Yeah.
So
you
even
include this, right? Because the risk-free rate is of the 4% of bonds is like a classic place to park your money, basically.
Right?
So that's kind of an assured return of 4% that you use as a let's call it an existing alternative, right? It's not necessarily a good alternative, but it exists if you want to take air quotes less risk. That's another debate if T-bills are risky, but nominally there's a 4% return.
And you actually have to allocate some to cash because you take the best asset, Bitcoin, you shouldn't be allocating more than 75% according to Kelly. So the rest should be in cash, just T-bill, waiting for an opportunity when the price pulls back. And the idea is that you rebalance, right? And the rebalance window is very, very important. So this is for an annual rebalance window. And for Bitcoin, the longer your window is, the higher the Kelly fraction. Actually, if you use 4 years, you'd have a Kelly fraction of 100% because every 4-year period has been a winning period.
Yeah.
But the problem with doing that is you'd only have 4 data points, so your statistics are poor.
So the rebalancing is in between, right? So if the price goes down, you go below your 75% total allocation in your portfolio, and you can use the part of the 25% cash, the cash you had to buy more Bitcoin to get back to that allocation. Right? Okay. Yeah.
That's the idea.
Yeah.
Okay. Now Bitcoin, we've talked about a little bit about how the return actually drops with time. And we had some crazy years in the beginning, right? That we don't expect to see again. If we just go back to that slide for a moment. This third one, 1,449%.
Yeah.
We don't expect to see that again. Here's another one, 300%. Yeah, we might see that. So I've also calculated with 5 years only, just to mitigate or see how strong the effect was. Yeah. But it's great still. I mean, the B drops to 2.4, but the the computed F is now 71%. It didn't drop that much at all. Now, if you were to pick just 3 assets, Bitcoin, broad tech, and gold, and look at their F values and then normalize everything, it would say 52% Bitcoin, 42% broad tech, 6% gold.
Over 10 years, right? That's good to add.
Over those last 10 years.
Yeah, exactly. Yeah. Okay.
Okay. What about this year? This year, we have to adjust for, and we say, okay, we didn't get another, we're down this year, right? So instead of being 8 out of 10, we're 8 out of 11. So that drops us to 73% win rate. But interestingly, the B value goes up because the loss here is based on only 2 years, and they were very big losses. Whereas this year, we've got a loss that's very small. We're down like 5% or something for the year.
Yes.
So you average those 3, instead of it being a 70% average, it's like a 40 or 45% average. So then the ratio with the wins are still the same, and now the B value goes up. So the F value doesn't drop that much, but it does drop to about 0.68, about a 68% allocation. That's a 2-asset portfolio against dollars. And if you just say, well, just the past 4 years, then you do get a little lower value. You get about 60%.
Okay, I think this is a good noob question. You said the wins, the wins are still high, right? And I think a classic like investment finance disclaimer is right, like past performance is not indicative of the future, right? So I think a good noob question would be, why are you using still the 292% of the past? Like how can you take that towards the future, if that makes sense? That sounds like a noob question, so it's a good question. But like,
sure.
What I mean? Like why can you still use that number?
First of all, you've got statistics of small numbers, so you kind of have to live with what you've got, right? And over time, they roll off. But if you don't like that, look at the last row. That's just 5 years. And so there, the average win is 155%, so it's only half as large, right?
Yeah.
And the average loss is 64%.
Yes. Okay.
And then if I fold in, that's a ratio of 2.41. But if I fold in the latest 5% loss, that ratio actually jumps up to 4.4 because it gets weighted in with these other 2 numbers that gave you this one. Actually, that's 1 number that gave you this one.
Yeah.
So the 64% gets averaged with the minus 5%. And then this ratio goes up. So it does drop from 0.71 down to 0.59, but it's not an enormous drop. But it gives you a feeling, and you can, try these. And then, I would say the one thing is people should not go out beyond the edge, because the curve kind of rises like this and falls sort of steeply if you get out over your skis on this.
It's basically quantifying kind of like the risk appetite for a person who holds Bitcoin, depending on the time frame that they look at Bitcoin, right? So if you look at it, if your outlook is 5 years, you're probably towards the 59%, right? If your outlook is 10 years, then you could take the risk, again air quotes, to like 75% allocation if that is the frame of reference that you constantly want to use, not only looking back but also looking forward, right?
Right.
Okay.
And this actually shows how the Kelly fraction develops for 2 cases. One is where you have annual window, and the other is you have quarterly window. And it's a little bit longer series. It goes back like 14 years in the quarterly case and about 12 years in the other case. And sort of 12, 13 years. And you can see that in the beginning, it jumps up to 100%, and then it drops down, and it moves up again, depending on when the bubbles hit, etc. But it settles down, and for the annual, it ends up essentially at around 75%. This does not subtract out the risk-free rate, I don't think. Yeah, I don't think it does. And then the other one settles at around 50%. So if you're using quarterly rebalancing, you are going to have a lower allocation than if you use annual rebalancing.
Yeah.
Because you're just more likely to win if you've looked at a full year.
Yeah, this is illustrating my point, right? Just depending on how and when you want to allocate, right? Or like kind of like rebalance your risk, so to say. It's funny because this shows that HODLing, right? Just HODLing is giving you a better result also, right? And that I find one of the most fascinating things about this. Like the math backs up the meme. Right, so just HODL, and you don't have to try to like time the market and constantly do this reallocation. But again, like that is connected to what I said before. It just depends on your understanding and your own conceptualization of what Bitcoin is by itself, and then also compared to all the other things that you could invest in, right? So I you know, there's different pieces of understanding and weight also that eventually help a person create their own investment thesis and allocation and risk appetite. But I think it's very interesting that the math connects back to the meme. So HODLing is preferred in that sense.
Yeah. This is a different technique. It gives somewhat similar results. It's called MVSK, and it's kind of like Sharpe ratios, but it adds skew and kurtosis, which is the S and the K. And you do the same thing. You take out the power law trend and then look at the residuals. And this is showing the percentage in a 3-asset portfolio, actually, with both gold and stocks. And even then, you're above 50% in most cases. And what you have on these two axes is the skew and the kurtosis weight. So if you look at the 1 for the beta, that's how much weight you want to put on the skew, which is the moment out. This is MV is mean and variance, right? So these are the moments, and the skew is the next moment. And then how much you want to weight the kurtosis, and that's the lambda. So if you just say 1 and 1, you're going to be 58%, even in a 3-asset portfolio with gold and stocks. Okay. But I want to move on because I want to get to the log periodic stuff. That's just Buffett saying, don't over-diversify. If you know what you're doing, you can HODL. Okay. This is Bitcoin against the dollar. It's the log chart. Slope 5.7, 5.9, depending on whether you use ordinary least squares or whether you use quantile. It's just 2 parameters. There's a constant in front of everything, and then the K is the power law index, which is very similar for the 2 techniques. And then you can see the projections there for December of next year. If you're on the mean or the median for the QR, you'd be around 160,000 a year from now.
Yeah, and maybe that's not this slide. You probably have another slide, but what you sent me up front is that when you talk about the existence of bubbles and basically put aside the 4-year cycle frame, and you just look at the math, right? You say your timing suggests like a very strong 2026 in the second half, like leading towards a peak more like mid 2027, and then something similar for gold. But now, because we're under the power line trend, basically what you're saying, what the math shows you, is that we are looking towards a catch up back to the trend and then back above.
Right.
Is that correct?
Right. And to set up that discussion, note first that the first bubble was in 2011, the next one was 2013. So that gap was a little over 2 years, nothing like a 4-year gap. Then 2013 to 2017, yes, you had 4 years. 2017 to 2021, It actually was less than 4 years. It was more like 3.3 because the left shoulder in April is higher relative to the regression line than the right shoulders.
Yeah. That was more like a double top also.
Right, double top.
Yeah.
Okay, how to calculate the growth. The formula is you take the ratio of ages, you raise it to the K power, and you subtract 1, and that gives you the percentage growth. So if you want to look at 1 year, it's t plus 1 divided by t raised to the K power minus 1. And if you do what's called a Taylor series expansion, you kind of only need the first two terms. The first term is just K over T. So if K right now is 5.8 and our age is 17, that gives you 34.6%, 0.346. And then there's a second order term that goes as a square of that K over T. It gives you another 6%. So if K is 5.87, you're getting about 41% as the projection for the next year for the main trend, how much you would expect the main trend to grow. So that's kind of the fair value price on trend.
Yeah.
Yeah, there's a trick that you can do. If you use the OLS index, that's 5.68. If you increase the age by 50%, you're raising 1.5 to the 5.68 power. That's exactly 10.00, just by coincidence. So increase the age by 50%, you expect 10 times the price. So if we're age 17 now, you add 8.5 years, you're at 2034.5 because we're at the beginning of 2026. And you expect over 1 million on the power law trend because right now the power law trend's it's a little over 110,000.
Mm-hmm.
And then another 12.75 years after that, you'd expect to be at 10 million or above on trend. And that would be early 2047.
Yeah. And on trend would also be, is that the same as fair value then, right? Because it's...
yeah, that's my fair value, quote unquote.
Yeah, exactly. So the, what does it say? 2034, like half. Yeah, so I think the estimates are kind of between 2032 and 2035, depending on, like it could hit 1 million before, right? If it's in this bubble above trend, right? But basically you're saying within 10 years, we are at... a million on the trend. Doesn't mean it could be a bit over, doesn't mean it could be a bit below, but just like you now calculated, I think around what was the fair value now? It's like just over 100, right? That would be the fair value at that point, yeah.
Right.
And this, sorry, if you go back, yeah, and then because this kind of shows the speed that you talked about before. Right, 2047, the 10 million. So although when you look at the power law and you see the diminishing returns in percentages, the absolute nominal amounts are at a totally different level, right? Like so
it drops kind of a couple of percent as you go from age 17 to age 18. That kind of a thing.
Yeah. But I mean more the I don't know if the correct word is exponential, but like just the going from the 1 to 10. So you see it takes longer.
Yes.
Right, from 8.5 to 12.75. But it's still predictable. That's the whole point of the power law.
And it's still rapid. This just shows the stability of the power law over time. It started out noisy. It shot up. There's the big bubbles in 11 and 2013, and so it shot up above 10. It's just if you measured the power law at any given time and you only had the data up till then, what would you see? But by 2016, it dropped down to 6. And then since then, it's been relatively stable around, 5.6, 5.7, 5.8 kinds of numbers. Right now it's 5.68 for the ordinary least squared. And this band around here shows the uncertainty, which has gotten smaller and smaller. This shows how the volatility has come down.
Yeah, that's what I remember from our last conversation. Is that really struck me. That is also why I say, like, okay, this is not an opinion, right? It's not an opinion. Like sometimes you see people try to say, oh, the power law is an opinion, but this actually shows almost like a constant in the level of certainty slash uncertainty, however you want to define it, right? But I think that actually is extremely interesting. Like this is not a random a random formula or calculation that you're following. Apparently, it is something that stays predictable within a certain range, right? Like there's
yeah. It's, to go into the physics of it a bit and the physics of networks, if the networks have structure and they develop like fat nodes, where you've got some fat wallets or you've got some exchanges and so forth, and they have preferential connectivity, that tends to give rise to power law behavior. And it's stabilizing the system, actually, so that it doesn't behave in an exponential manner, because exponentials run away on the upside, but then they crash on the downside. So its exponential can be in both directions, right? And this is like a system that's operating kind of at the edge of stability, but it's self-regulating. And you can model it as having this kind of spring-like motion where you get liquidity waves come in, it moves up, you get a bubble, but you get liquidity absorption and you get restoration back to the power law. And you could model it with dynamics and include a spring-like term to restore.
Yeah.
Okay, this just shows, though, that the volatility has come down, and not for the points that are below the line. If you split into, you can split into two bell curves. One is for the bubbles and one is for the core behavior, essentially. And what you find is the volatility has been flat, the green line, for the core behavior, but the bubbles, it's been coming down. So it was a factor of 3, and it's cut in half to a factor of 1.5, 1.6. This shows the same kind of thing. It's basically come down as a reciprocal of time. And this is now looking at the bubbles, setting a threshold and saying you have to be above a certain threshold of 0.2 in the log 10, which is the current 1 standard deviation. And you need to have at least a 10-day duration. And when you do that, you see a bunch of tiny bubbles and anti-bubbles, both directions, but there are only 4 that really stand out. And they're the ones we all know in 2011, 2013, 2017, 2021. If you take out the power law, you get the lower chart. And you can approximate the energy by drawing these triangles. And the triangle height and width is just measuring what's above the green dash line. So it's only if it went above the threshold that it's represented by the triangle. And you see the other things are just noise, pretty much. Although there are fewer and fewer even of the noisy ones. And the energy has gone down in the bubbles. And the distance between them is about 2.5 years, 4 years, and about 3.3. And we've had no bubbles since mid-2022. So I believe the 4-year cycle is invalidated by 2 things. One is 2011, which everyone likes to ignore, and then that we've had no bubble in 2025.
So translation would be...
Well, I'm going to show you.
Like bubbles up and down are noise, right? And the signal is basically a constant growth, right? There is one direction.
You don't get big anti-bubbles. In other words, what you get is you get bubble motion up and then restore to the power law and below the power law, but not as far. So if you say your threshold is 0.2 in log space, you don't get below that very much. In other words, the right tail's a lot bigger than the left tail, right? You can fit a bubble with this log periodic power law that's been popularized by Sir Nat for a variety of phenomena, including financial markets. This was a projection I did in July, and it said we could get a peak in mid-September. It turned out to be early October. And so that was one case when it's right. It's pretty tricky to use this thing because it has 7 parameters. So you need to always be rechecking and tested on different scales. But it's this log periodic parallel that was the motivator for how you fit the whole series of bubbles. And actually, Giovanni did this back in 2019. And so he only had the 2011, 2013, 2017 large bubbles. And he fit something like this, but it's a slightly different formula because with the one that I showed you before, it works up to a critical time, and then the idea is that there's a crash. And we kind of saw that, right, in October. In this case, you just run time forward, and so you get these waves going forward. And so he matched the 2011, 2013, 2017, not necessarily the peaks, but when they occurred. And his projection is the next one would be at age 18, actually 17.96. And he's got it right there. He's got the X value. It's the log of number of days, and it works out to be 18.0 or 17.96. Now, I've now got 6 years more of data, so I've got a somewhat more precise reading on this. But the spirit is the same, and the idea that it's log periodic, that the spacing interval grows by roughly a factor of 2. And the age went from 2.45 to 4.9 to 9. And so you can see that the bubbles are getting further and further apart.
Yeah, this is interesting, right? Because this is what people also talk about with regard to gold, that I don't have the periods on top of mind, but there was basically was that the introduction of the gold ETFs? I think that was it. That they also talked about, like, gold basically had a 7-year kind of like a bull run. I find it interesting that there is a certain behavior that you now show with Bitcoin also, that it's kind of like the volatility dampens, and the space between the bubbles gets longer, which in my mind would translate to a good thing. That means like Bitcoin is actually an established, or becoming an established asset that is a like in a serious consideration for people to put in their portfolio, right? Like that whole argument of, oh, it's volatile, etc. That's basically this graph, I think, showing that is a non-argument, basically.
Oh, over time, I mean,
exactly, yeah.
You buy Bitcoin at the volatility you can handle, right?
Yes.
And so higher tiers of capital come in, and their institutional capital. There are two things that they expect: that they understand the volatility and can manage it, and in general, they would like lower volatility. And the second is that Bitcoin is expensive enough that if they buy some, that it makes a difference to their portfolio. And this is why Apple hasn't bought a lot of Bitcoin yet, because they cannot change their life by buying Bitcoin. Saylor could change his life because he had a small company by going all in. But as Bitcoin goes to higher and higher value, it attracts higher tiers of capital. And this is actually a dynamic behind this log periodic behavior. You can model it with a simpler kind of equation that has 5 terms, and it's got this log spacing parameter, which is lambda. And it relates to the angular frequency, which is in this cosine term. It's cosine of omega, which is an angular frequency. And then there's a log of the time. And there's a phase term. So that's essentially what we're modeling to time when the peaks happen. So in order to do that and extract that lambda value, I did a Fourier transform of the data. First, I determined the residuals. I did this for both gold and dollar, but this chart is Bitcoin measured against gold, because I thought, well, I don't know, for fun, let's try it against gold first. And so these are just the residuals. The parallel is taken out. I do the Fourier transform, and I find that this fundamental parameter lambda has a value of 2.07. It's a 5.3 power law, as I showed you before. And you can see the residuals are the peaks, and the bubbles are quite well defined and sharp. And then the red lines are the fundamental behavior with this parameter lambda equals 2.07. And you can see they line up right with the peaks. And there's a phase term, and it's not too hard to match the peaks. But once you've lined those up, where's the next peak? Well, it's out here way on the right. It's at age 18.4. So that's May 2027. And that's when you'd expect the next fundamental peak. So that explains 2011, 2013, 2017. Well, what about 2021? People that play music know that, you have C and then you have the next octave is a harmonic. And you can have subharmonics, so you can have the lower octave. And those are slower. So the first harmonic's faster, and you see three, they actually happen in this case, they happen in between the red ones. They happen logarithmically in between. So it's like the square root of this 2.07. So there are three blue vertical lines marked, and one of them lines up with the 2021 bubble. And the other two don't work that well. They sort of kind of fit against local peaks, but they're not very large amplitude. And then the one subharmonic is only one because it's slower, appears, and it does line up with the little bubble, roughly, that happened in the 2019 timeframe. Mm. So I suggest that this is a better explanation of what's going on than a 4-year cycle.
Yeah, I think.
Yeah,
it's interesting because some people would argue that kind of like the 2021 bull market, that people would expect when they follow the 4-year cycle was kind of like a muted thing. Right. Although it kind of went up crazy, but it was also a weird period with COVID and stuff like that, right? So I think that's a general thing that people say, like, oh, that was kind of like a muted bull market. So that's kind of what I'm recognizing here. And on the other side, what people kind of like say now is, okay, maybe 2025 was almost like a bear market year, right? Like that there hasn't even been a bull type market. Let's call it, a rising market. I don't think bull and bear kind of applies to this, but I think that's what the graph does show, right? There's like this very long, almost like a chop solidation type behavior here that I think a lot of people discuss, but you're showing that this is actually part of the mathematical behavior in a sense. That is not illogical to see this. This is kind of how I would translate this in my head, right? So people create certain narratives to talk about what is happening, whether that's correct description or not, I don't know, but I think it's interesting that the math does kind of like match how people talk about the market that we saw, like 2021, or like what is happening now. And when I look at this, I think that then there's some interesting times to come, right? Like the coming 12, 16, 18 months.
18 months, yeah. Now, this value of 2.0 is characteristic of a lot of other physical processes. If you look at earthquakes, a typical lambda is 2 to 2.4. Rock fractures, it's around 2. Fluid turbulence cascades, around 2. Tremors in volcanoes. And even the financial bubbles, if you look at the tail distributions, even in stocks, you can find these. In ecology and in statistical physics, they all kind of around 2, or, not too far removed from 2 for this parameter. I also did this with a technique called wavelets, and it found several wavelets, but they were all between 2.0 and 2.1, so they were consistent. Broad idea is that you're seeing the capital inflow come in discrete hierarchy tiers, And it takes longer and longer for Bitcoin to have its price go up by a factor of 10 with the power law. So it takes longer and longer to get these big new entrants of capital, whether it be the treasury companies or the ETFs or earlier on hedge funds. And so when the price gets to a certain level, it kind of opens it up for the hedge funds to come in or later for the treasury companies to come in. And that helps drive, a bubble, and people kind of jump on when they see the price momentum as well. But eventually that's overplays its hand and it comes back, to below the power law and then catches up to the power law.
When you say this is such a clean result, how surprised are you by the fact that Bitcoin, again, apparently behaves so predictably, or like according to almost natural law, right? Like the power law you see in nature, and that, my conclusion here is that this is not a random thing, right? Like this is not a random product that is introduced into a market where, well, some people might see the value and buy it, and other people don't, right? Like there's not really. Well, there's a surprising amount of predictability, let's call it that, right? And I think that by itself is something that is very hard to, I almost want to say, create, right? Like with just random new companies going on the market with their IPO and stuff like that. They are way less predictable than Bitcoin, right? So how surprised are you by that, right? Or how special is that? Maybe that's a better question, right? Like why should you pay attention when you're seeing stuff like this?
It is special. Bitcoin belongs to a set with one member. It's unique. There are thousands and thousands of companies that trade on public stock exchanges. There's no crypto that's like Bitcoin. They don't belong to the same set that Bitcoin belongs to. And, I think, we know why. It is a definitional scientific standard for money rooted in energy and cryptography and built on a network that has achieved, it's past the level of critical success. And it's built this structure. And really what this is saying is that it has this structure that's self-reinforcing. There's a word for it. It's called autopoietic. It's self-reinforcing. It has to live in a larger environment, but cells are autopoietic. They have to depend on organs, but they're self-organizing. They have their own rules of self-organization, and then they absorb energy and resources from the environment. Bitcoin is autopoietic. It has its own rules of its organization, but it absorbs fiat into the environment, and it incentivizes humans to go out and mine it, mint it, and to run full nodes, right, and to participate in the ecosystem. Yeah. Because of what it does, and it incentivizes new tiers of capital to come in as it grows its price in this parallel manner.
It's very interesting. I Googled it. I never heard this term, but it says the core idea is self-creation. So the system's processes generate its own components and organization. It's self-maintenance. It defines and preserves its own boundaries. That's interesting, right? Because that is if you think about Bitcoin as this like 3D cube with the 21 million units, and like all the energy is basically captured in that, but also the protocol has boundaries, right? There's just a set amount of rules, and that's just it. Like the rules live in this system. And then the third one is autonomy. It's self-producing and self-sustaining, not dependent on external creation, right? And I think it's so fascinating that a lot of these things come together. Just the idea of a protocol enabling something that is digitally scarce, I think, is one thing, but also the amount of like taking physical energy, which is high entropy, turning it into a low entropy, basically immutable database that the longer it lives and the more data it stores, it becomes more trustworthy. So more people are gravitated towards that, right? They mine and they have wallets and more addresses and stuff. And so it's all these elements together that kind of fuel this reinforcing loop. That is, do you have any outside of human body? That's the example I saw, right? Are there any like other systems that are like that? Because it's pretty wild if you can compare Bitcoin to like how a human cell behaves.
Sure. Galaxies are like that. There's self-organizing.
Yeah.
Self-sustaining, but they also interact. They interact with their neighbors, or they have, as they form, gas comes in. They do suffer collisions, and they'll reorganize when they have collisions. And they show this kind of same kind of capability. They have a power law in terms of the continuous behavior of the spiral arms, but they also have this log periodic behavior in some of the details of the spacing of those, or when you have branching and those. So that's another example.
Wild. It's wild Bitcoin is at that level. I just think that's mind-blowing that again, apparently this is so, yeah. All right.
Now, if you want to know when the peaks happen, you can do this weird numerology. You could just take this lambda and add it to 2009. That gives you your first peak. You could take lambda squared, that's your next peak, lambda cubed, 2017, lambda to the fourth power, 2027. And then the one after that would be 2047.
Wow.
And the value spacing, the price and the market cap spacing is lambda to the k power. And we know k is about 5.7, and lambda is a little over 2, and this turns out to be 60 times. So very roughly, you're going to see 60 times increase in market cap as you go from one to the next, to the next, to the next. Maybe eventually you saturate before 2087, right? And you become, hyper Bitcoin happens, right? If we keep going by that time. The 2047 takes you to, as we said before, something of order 10 million or so, which is over 200 trillion. And that'll put it in a roughly, won't be quite as large as the future M2 of the US dollar, but it'll be in the same class of that.
So hodling is going to be harder.
Hodling is going to be harder.
Right?
Yeah, but you can afford to sell a small amount and hodl the rest. Right?
No, I agree, but I think it's just interesting that
exactly.
whole idea of your own proof of work is going to be tested the longer you own this asset, right? Like, can you? That is why I also love this stuff. It's kind of like if you follow the math, that's quite reassuring in a sense that you don't your ego and like your own perception of adoption or the speed or however that's mixed with your wants and needs and desires. You can kind of like put that aside and follow the math also as a guide in holding, and also understanding not only the direction but of like the size where this is going, right? So yeah, I think it's very interesting.
Actually, I thought I would close with this slide. This is the comparison of the 4-year cycle to the log periodic bubbles. So the bubble years down here, 2011 through a future possibility in 2027, and noting there was none in 2025. And so 4-year model ignores 2011, says yes to 2013, 2017. It was correct for 2021. It failed for this year. The log periodic is correct for 2011, 2013, 2017. It says that 2021 is the first harmonic of that same fundamental mode. It explains why there was nothing in 2025, and then we have expected in 2027. So we're right 5 times so far, as opposed to being wrong 2 times. And the other thing is you can measure the RMS error, and that's, how wrong is your prediction relative to when the thing actually happened? And in the case of the 4-year model, your average error is over 1 year. It's like 1.2 years. But for the log periodic, you're only off by half a year. So it's about 3 times better in terms of the error.
Fascinating, man. Like, thanks so much for taking me through. Like I just said, I think this, for me, as a non-mathematician, I think it's very helpful to see that there's like practical guidance in the math, right? I think it's amazing you're doing this work, and I really also appreciate your time just sharing that here. I'm gonna link to your socials and stuff like that, so people can follow you. And yeah, I hope we can do this again, like do some updates, see where we're at.
Right.
And I want to thank you for your time. I really appreciate it.
It's been my pleasure. Enjoyed being on again.
Likewise. Thank you.
Thank you.
I hope you enjoyed this episode. If you did, you can click here to find more just like it, and click here to find all Bitcoin for Millennials podcast episodes. Also, please like this video if you want to help shine a light on the message of Bitcoin, and subscribe to my channel to stay connected. I hope to see you for a next episode. Bye.